And just a little hint of a slowing labor market. And what do we see? We see those interest rates just trickle down just a little bit today. And that, my friends, is great news. What's going on, y'all? My name is Kevin Weedmark, a.k.a. The Mortgage Mouth, coming to you with another episode of the Daily Dose. Make sure you hit that subscription button so you do not miss a beat, where every day we cover what happened in the marketplace, how it affected interest rates, and what can we expect moving forward. So what did we get today? We got a couple pieces of information. The big mover was the New York Fed came out, and essentially in their report, it is showing that consumers believe that the labor market is not doing well. And again, perception right now is reality with the continued shutdown of the government and no big data sets coming at us. We only have to go on what we knew and what we think, kind of flying blind what we're getting from these third-party data sets. So that was number one. The second thing is there's a group that came out today. It's called Carlyle. Haven't heard of them. Need to dive in. Need to see if this is something they have been doing for quite some time and the accuracy of their information. But they're estimating that last month there was only 17,000 jobs created. Yes, folks, that's right. You heard it right. 17,000. I mean, what a joke right now the labor market is. The estimated on that Nonfarm Payroll last month was only a mere 54,000, I believe, if my memory serves me correctly. So if we're looking at 17,000, you can be certain that if that was the number on that Nonfarm Payroll number, we would see lower interest rates. But again, we are in a government shutdown, so it's good. Everyone is flying blind. So it's going to be third-party information like this, and depending on who it's coming from, because that other set, that Carlyle Group, it didn't move the needle at all. It's just kind of reconfirming. It's sitting out there now in the back of everyone's minds and has them spinning a little bit. So as long as this government shutdown continues, it's going to be really hard for people to jump into treasuries because of the uncertainty. They're flying blind. The new norm of inflation is 3%. The yield is paying what? A little bit over 4. There's not much money in that. And what you see things like sure things like gold. You're seeing Bitcoin. You're seeing the whole crypto space make a rally. People feel a little bit more comfortable in those spaces. And again, I have to constantly remind everybody every day, traders need to make money. Their job is to make money for themselves and for their clients. So they are going to follow trends. They are going to move money into trends. And depending on that data right now, while we're all flying blind, that is what's going to be dictating the market. And unless we see data like we saw today from third parties that indicate that labor market and that economy is weak, no one's going to be putting money into treasuries. So again, lock those dips. And hey, we live for another day. Be coming to you tomorrow with another episode. Again, hit that subscription button. Cheers.